This is an interesting one. Popped up today. Medical Properties Trust. Ticker symbol is MPW. It's a real estate investment trust, or a REIT, in the USA. Pays a dividend 4 times a year, and the current dividend yield is 10%. But it really does not look good, to be honest. The thing is, though, when I had a look at the fundamentals and did a little bit of reading about it, I think it might just be oversold. Obviously, now what do I know? Could be completely wrong, but just to have a quick glance first. 60% profit margin over the last year. There we go. -12 in the last quarter. So it's having a rough time at the moment. And then the annual debt to assets is 56%, and over the last quarter is the same. So according to this, both their assets and their debt have slightly gone down, but they're the same relative to each other from previous quarters. But I do know that in environments of high interest rates, real estate investment trusts tend to suffer. And to be completely honest with you, any company paying out 10% dividend yield is taking a risk. It would make a lot of sense for this company to drop the dividend, maybe completely, if not reduce it drastically. Because here, 2020, even at the bottom of the lockdown drop when nobody knew what was going to happen, $14 it dropped to. Then it kind of bounced back a bit up until, did quite well, back to where it was within 2 years. And then from January 22 to now, it's gone from $24 down to $5. Now the previous graph was just trading 212's data. This is a more accurate long-term graph. So it appears that we've been worse before. $4 had dropped in 2009, just after the 2008 financial crisis. And the company was founded in 2003, and this graph goes back to 2005. So it's a pretty good long-term scale of what's been going on. But the lowest it's been in the last year is $4.92, and we're now at $5.23 a share. The highest it's been in the last year is $14. I'm going to have a look and see whether or not it's worth anybody else putting any money into it. I'm going to, because of the strategy that I use. I'm going to max it out at about €100 like every other position and then go from there. But I would not want to encourage anybody to put a lot of money into this because it doesn't look great. Now, the difference in the last year to the last quarter is drastic, but it could recover very quickly or it could continue falling down to nothing. And a good way to think about this is if you bought in 2005, 2 years after this company was founded, you will now have lost money. You'd have lost 52% of the value of whatever you put in. There is dividends along the way, but you could put money into this now and it may not recover for a long time, if at all. This is a risky one. So here we go. The fun begins. Class action lawsuit and an upcoming deadline on Medical Properties Trust. So the period that this relates to is between May 23rd and August 17th of this year. And it says, if you're a shareholder who purchased or otherwise acquired Medical Property Trust securities, you have until November 28 to ask the court to appoint you as lead plaintiff for the case. So rather than bore you with all of this, I'll just leave it up here if you want to pause and have a quick look through it. But the general gist from this and from a couple of others that I've seen is a lot of mentions of a lack of transparency, or in layman's terms, sneaky. People were misled and facts were omitted, which never looks good. And it says defendants, which is Medical Properties Trust, they made false and or misleading statements or failed to disclose that this plan called the recap transaction, which is a recapitalization transaction, and they overstated the approval prospects and the benefits of this transaction. So they talked themselves up, let's say. Oh yeah, sorry, this article is on Benzinga if you want to have a look at it yourself. But this recap transaction was with a company called Prospect Medical Holdings. Medical Property Trust would take an equity stake in Prospect's managed care business, which is PHB Holdings, in lieu of a cash payment of outstanding loans and accrued but unpaid rent and interest owed by Prospect to Medical Properties Trust. So there's some dodgy dealings going on that a lot of people did not like. And an overall look at their fundamentals, there's a lot of what seems okay or good and a lot of what seems quite bad. So if the price is $5 a share and the dividend per share is $1, that's outrageously high. It makes sense for them not to pay that. Earnings per share has plunged 95% year on year, 78% down from the previous quarter. Here is quite a lot of key statistics that I'm not going to bore you with, but I'll leave it here if you want to have a look. Dividend yield down here, 19.5%. There's absolutely no way they're going to pay that. And the payout ratio is 927%, according to this site. So that means they're going to pay 927% of their profits out to shareholders as a dividend. Not going to happen. So they're having a rough time at the moment, which is a gross understatement, but net income has dropped 94% year on year. Net margin shrunk by 93%. Operating income decreased 44%. Gross profit decreased 38%. They're getting hammered, is the easiest way to say it. Pretty rough. However, I do often hear it brought up that during I think it was the .com crash, Amazon shares fell 97%. It would have been an absolutely massive risk at the time for you to buy in. Probability of them failing was very high. And if you bought those shares 97% down and held onto them until now, you would be very, very well off, to say the least. Now, although it is tradition to have a look at the long-term dividend history, I would say this is going to change very soon. But we'll have a quick look as far as it goes back. We'll get a good scale of whether or not they like raising the dividends. 2013 went up by 1 cent. 2015 went up by another cent. It seems to be 1 cent at a time. Does pay 4 times a year, but it is technically being raised, but not by much. And then here we have between July and October, it went from 29 cent down to 15 cent. So I can imagine it's probably going to fall a lot more if they even pay the dividend at all. Yeah, it's very, very risky. But thankfully, because of the strategy I'm using, I can still put some money into it, forget about it, and worst case scenario, I will lose less than 1% of my overall portfolio. So this one is certainly a spicy one. Now I'm 40% down on it. I only put about €35 in. So I think the best thing for me to do now would be to put another maybe €25 in and just hope for the best, because it's really not looking too promising. Now, I could be wrong. They could suffer for a little while and then recover. And they do have quite a lot of wiggle room. They got 444 properties, which are leased or loaned to 55 operators. Current market cap is $3.3 billion. Price to earnings ratio is 5. Revenue of $1.5 billion. Earnings per share of $1. And a dividend yield of about 11%, which is not going to be paid. Doesn't make sense for any company to pay 11% dividend yield, but it is a bit of a tough cookie, and it's a difficult one to call as well. I honestly have no idea what way this could go. So the cash flow from operating over the last year was 740 million. From investing was close to 400 million, and from financing was negative $1.34 billion. But as always, it's up to you to make your own mind up. I'm going to throw a little bit into it, see what happens, and let me know if you hold this stock and what you think of it.